Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Last couple of weeks, we've had market spotlights. Today, we continue that trend with markets on the move. We'll take a look at a whole bunch of markets across the U.S. and the world and how they're performing right now. Today on the Real Estate Guys radio program.
Stop for a moment. Why are you listening to this show? Are you dreaming of a bigger, brighter financial future? More personal freedom to live life on your own terms? What if there was just one skill that could make it happen? There is. Sales. Robert Kiyosaki says every entrepreneur must be good at sales. It's true for investors too. Sales is how you attract money, people, and opportunities. Sales is the skill used to negotiate deals and lead your team. Sales skills are essential to success. The good news is, it's a learnable skill. The great news is, we've created a 2-day interactive workshop to teach those skills to you. Make plans today to attend How to Win Funds and Influence People, Mastering the Art of Financial Selling. For dates and details, send an email to sales@realestateguysradio.com or visit realestateguysradio.com and look under events. Gain the skills you need to succeed. Email sales@realestateguysradio.com or look under the events tab at realestateguysradio.com.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. With me, as usual, it's our financial strategist and co-host, Russell Gray.
Hey, Robert.
Just finishing up the secrets of successful syndication. Had an amazing group of folks, more than 200 people come out, and oh my goodness, what an amazing event. And the speakers were fabulous. The faculty was fabulous, but the most fabulous, the people that came.
Yeah, this event, for whatever reason, just tends to attract a higher caliber person than you often see at a lot of real estate sessions, and I'm not disparaging any of those folks. It's just that these are people that have already figured out the bread and butter, the basics of real estate. They know how to make money in real estate. They understand how to get deals done. And now the only thing really holding them back is they don't have enough money to keep making bigger down payments or doing bigger deals. And so they can't scale for the lack of capital. And of course, once you realize what syndication is or can be for you, you realize there is no lack of capital. In fact, there's so much money that is looking for a place to be put to work. If you know what you're doing, or you know somebody who knows what they're doing, that you can direct capital and put it to profitable use, you're going to get a lot of capital that's interested in flowing through you into those profitable deals.
We've talked the last few weeks about particular markets. We do these market spotlight shows where we'll focus on a particular market and learn from providers in that area that know the market well, and that's always popular. And you listen to that interview of those shows with the idea that maybe this is a market for me, but the bigger picture is, what are the signs in a marketplace? And so today we're talking about markets in the move. A lot of information comes out after the first of the year, so it takes a month or so to accumulate all the data on how did markets do in 2018. So a couple of really interesting things. We're going to talk today about some markets that are on sale, that markets that have come down in median price around the world. Now, we're heard in more than 190 countries, but we are based in the United States, and our number one listening audience is in the United States, but a lot of reasons to consider going out beyond the place you live. In fact, at the event, we had folks who flew in from Australia, folks that flew in from Dubai, folks that flew in from all around the world and the country to not only network but learn these ideas. And it's like, yes, syndication works everywhere. Real estate investing can work everywhere. So we're going to talk about some specific markets that are on sale. Meanwhile, CoreLogic has come out with their estimate for the median home price difference in 2019. And just to cut to the chase, they do a lot of research, a lot of study. They look at markets across the U.S. They talk to a lot of folks. And their culmination of all that, it would take hours to read the report, is that they expect median home price in the United States for 2019 to go up approximately 6%.
Which is kind of the average for a long, long time. It's funny, you look back over that little aberration in 2008, and certainly not saying it couldn't happen again. There's no linear track or straight line in anything, but you do look for overall trends. When we wrote Equity Happens, one of the major premises in there was that we're in an economic system where we know that the purchasing power of the dollar over the long term is falling. And that's pretty easy to check. We're not just saying that, certainly not conspiracy theory. You can go to the St. Louis Federal Reserve website and you just go to the search engine there and ask for the purchasing power of the dollar, and you'll see the 105-year trend is basically down. So if you understand the concept of it taking more dollars to buy the same things, then it would stand to logic, the more things that you own, the more dollars they will be worth over time. And real estate is the perfect vehicle for taking advantage of that trend, because you can lock in the price today using dollars from the future by taking out a loan, which is effectively shorting the dollar. You lock in the price, you lock in the possession of the asset, you lock in the interest rate on the debt, you lock in the balance owed on the debt, and then over time, inflation and equity happen to you. Now, of course, we recommend that you do things like buy under value and add value and have a strategy for managing rents. And one of the most important factors in strategically positioning a piece of real estate, not just to take advantage of inflation, but also a supply and demand dynamic. When you look at price escalation or price changes, deflation or inflation, there's three core factors. You have inflation or deflation, which is the purchasing power of the dollar for the same goods. If I can buy something for less dollars than I did before, then that means it's deflating. The dollar is getting stronger and I can buy more of something for the same dollar. We don't see a lot of that in our economy because of the nature of the system. Inflation, as we just talked about, is the opposite, and that's where it takes more dollars to buy the same thing. Supply and demand also causes prices to go up and down, but it isn't a factor of the power of the dollar. It's a factor of what people want relative to something else. And so when a product or a market or a product type gets hot and more people move in or go to get to that particular product, service, asset, whatever it is, they bid it up and something is going down in order to feed the up on the other side. So supply and demand is a zero-sum game. And the third factor is leverage. Leverage is bringing purchasing power or dollars from the future into the present. And this is one of the great ironies in the government's attempts to make things affordable. They will come out and they will create cheaper financing to make housing more affordable. And the net result is it becomes more expensive.
Yep.
They create student loans in order to make education more affordable. And the result is it becomes more expensive. Apparently, they don't understand that when you give people the ability to grab more dollars from the future, it gives them more purchasing power to bid the price up in the present. So when we look at markets, the main thing we're looking at, because the economic system is universal, it's really a supply and demand issue. Are people leaving? Are people coming in? And there's some factors that affect that. And so when you look at these market reports, you're seeing what happened. The real fun part is to dig into each market and try to figure out what happened and why it happened, and then look for patterns and principles so that you can begin to recognize those emerging trends in other markets and try to get ahead of that trend.
That's exactly your mission as a real estate investor. We could only get market data in the rearview mirror. In fact, most of what we're going to talk about today is what's happened last year, and for the entire year, how the prices, medium home prices, compare till a year before that. So we see maybe the start of a trend, but the bigger picture, as you mentioned, is figuring out where the puck's going. That's the harder part, but you can see these patterns, these principles, these trends that happen, and then you can apply information that you get from other sources to really get the key. As people ask us always how we find markets, and for many, many years, we were able to take our students into the number one appreciating market in America a full year or more before it was number one. And it happened year after year after year. And it's like, wow, that's not an accident. Well, no, because markets leave clues. Having said that, we started with this premise that the median home price is likely to go up over the year. And as you've pointed out, there's a lot of reasons for that. And you can argue whether or not a median home price of 6% even matters if inflation continues and the dollar value is down. Ponder that for a bit. But all things being equal, finding a market where we expect there to still be upside makes sense. Now, before we get into the specific lists of markets, we got several lists of markets to share with you today, so we're not going to leave you in the lurch. We're going to actually be very specific about markets that we and some of our other friends enjoy and like and are pointing to, because you do need to have some tangible information. But the big picture is that's just an invitation for you to do the research. Just because we say we like market A and we like market B and we don't care for market C, doesn't mean that's the same conclusion you would draw. You have to decide in your own investment life Where do you want to be? Why? All those things. So you take a market that has bread and butter blue collar workers, and if I'm buying single family homes to hold for a long time, then what I notice in a market like that is these are folks that are good, hardworking folks who get up and go to work for somebody else and make enough money to pay rent, but they never seem to put enough money together to have a down payment and buy a home. So that's a great market for some folks. In other markets, we're going to find, like today, I'm going to share with you a list of the most expensive and valuable properties in the United States. These are markets that are pretty, let's say, not impervious, but a little resistant to what may happen in the economy. Wealthy people are generally wealthy people. They still go on vacation. They still make big purchases. They still buy beautiful houses no matter what the economy's doing. So that's just a point on the curve. Then there's markets, a lot of markets we're going to talk about today that are literally on sale because of the demand and supply imbalances you talked about. So a lot to think about. Do remember that when we talk median home price, that includes houses that people live in. And so as investors who want to put tenants in homes and in apartments and in retail buildings and in commercial spaces, we're not looking at the same demographic as someone who's moving because of the school district or their job.
Yeah, and again, when you look at markets, you talked about these personalities, I think is what you were alluding to. And we talk about when you go into a market, if you're a buy and hold investor and you're going to be taking advantage of locking in long-term financing, and so some of the reasons why you would want to do that is because interest rates still are relatively historically low. Dollars still have a relatively strong amount of purchasing power, and you can accumulate assets and the cash flows that support that in markets. But in order to play that game, it's a long game, which means that you have to spend some time really getting to know the market and the factors that support and drive the market, and whether those are sustainable drivers and whether they're going to be there 5 years, 10 years, 20 years down the road, whether they're going to improve or weaken. And so markets have personalities just like people, and you wouldn't marry somebody just because they happen to be the first person you talk to, or you wouldn't marry somebody necessarily because your best friend thinks that that person is interesting. It's a very personal decision, and it always starts, as we say, with your personal investment philosophy, what it is you're trying to accomplish. And if you're a regular listener, we talk about this all the time. Gosh, guys, why do you always say that? Because it's probably the biggest mistake that most investors make. They go out, and I just got done hearing a story about a gal that several states away, where real estate is very expensive, found out about a property in a market where real estate was very inexpensive, and bought in that market purely because it was such, quote unquote, a good deal.
Right.
But the property was inexpensive for a reason. There wasn't very many people there. There isn't a very vibrant economy. There probably isn't very great prospects for growth. And now what you've bought yourself is something that's going to cost you about 8% or, a big chunk of your equity just to get out.
Yeah.
And so you have to be very, very careful when you make these decisions, much like you would. I mean, people get married, and sometimes people have bad marriages and they break up, and that's okay, right? You can have long-term relationships, and sometimes they work out and sometimes they don't. But the point is you don't get into anything that you're serious about, that you're going to be in for a long time, without giving at least a little bit of thought. And it's just shocking to me how many people just jump out and buy a property simply based on the math on the property without understanding the economic environment, the market that it's in, and the overall underlying health of that market.
Now, having said that, right, you're looking to get married to a market long-term if you're a buy and hold investor. But if I'm a flipper, if I'm buying a property, fixing it up and selling it, which is real estate, but it's not investment, it's a job, it could be a great job, then I'm interested in markets that maybe are trending in the right direction price-wise and maybe more expensive. If I'm going to go to all the work to rehab a house, why not rehab a $300,000 house instead of a $80,000 house? Same amount of work, the cost differential, I'm going to make more money in the market. So I might pick a market short-term differently than I'm going to pick long-term.
Yeah, and so just for those of you, I thought I heard a couple of paradigms breaking out there. So just to clean that up a little bit, a lot of times people think about investing and they look at real estate as a method to generate cash. And so their investment thing is buy low, sell high. They're going to go from cash to asset to cash. And then when you finish that round trip, what you end up with is a pile of cash.
Sounds
Of course,
good.
yeah, it sounds good, but then if you understand that the long-term purchasing power or wealth preservation characteristics of cash is not good, ending up with a pile of cash really hasn't given you financial freedom. It's given you some capital to go build financial freedom. But a real estate investor, as opposed to somebody who's got the job of cranking out properties, whether you're a developer and you're building them and selling them, or whether you're a broker and you're just brokering the transactions, or whether you're on the mortgage side and you're brokering the loans, or whether you're a house flipper, you're going in and out of transactions to generate cash to asset to cash. We call that a job. We don't call that investing. It's a great way to develop investment capital, like wholesaling, but ultimately to be an investor, you're going from cash to asset to cash flow. And so the mission is to accumulate cash flow. That means tenants. That means doors. That means people who sign leases. That means produce or something that is going to grow year in and year out, season in, season out, and can be sold on the open market to generate cash flow, regular cash flow from operations. So it's really more like owning an ongoing business than just having a one night stand with a property and getting in and out and walking away with your pile of cash. So just understand the differences there. When we talk about markets, yes, markets need to be strategically chosen even for flipping. But when you're going to be in a longer relationship, you're pickier about who you choose to engage with.
Robert Kiyosaki says in Rich Dad, Poor Dad, the rich don't work for money. And this is a great example of that. When you go from cash to asset to cash, you're working for money. When instead you collect assets that create cash flow, now your money is working for you. You're not working for your money.
Yeah, you're accumulating or harnessing the efforts of others. I mean, if you start a company and every person you hire, you make a spread on their labor, they are more productive than what you pay them to do the work, you're making a profit. And you build a big company, the more employees you have, the richer you are, right? So it's the same thing. The more tenants you have in properties where the financing structure allows it to be positive cash flow, the richer you become. It isn't the property that makes you money, it's the people. And a market is made up, yes, of properties, but it's the people and the relationship the people and the businesses have with the real estate that makes the real estate valuable. That's why you can find these great deals in places where there's not a good relationship between the people and the land. And what ends up happening is you buy dirt in the middle of nowhere or a property in the middle of a sparsely populated area, and you just don't get the economic performance you thought, even though it's cheap. So you bought the property and you own the property and it's a beautiful property, but there's no people. So always remember you're using real estate as a vehicle, whether you're a lender or you're an equity investor, to accumulate or harness the efforts of others and collect cash flow on a regular basis from their efforts.
So where in the world do you invest? Well, that depends on your personal investment philosophy. A lot of markets are in flux and a lot of markets are in the move. We're going to talk about many of those today on the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, this is Peter Schiff, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Nothing happens until somebody sells something, and sales is such an essential skill. Even if you don't fancy yourself a salesperson to be a great real estate investor, you need to be able to persuade and influence. I can think of no better way to do that than to come on out to How to Win Funds and Influence People. It's a 2-day workshop that our very own Russell Gray conducts once a year. It's happening in June. All you need to do to find out the details, get to the website at realestateguysradio.com and click the tab that says Events. We're talking today about markets on the move, selecting a real estate market that makes sense for you, and really an invitation to study the markets. What we're not going to do is give you a list of the top 5 markets you should go invest in. You've got to figure that out. But let's start worldwide. There's a lot of markets that go on, markets that people look at to either vacation in or maybe to start businesses in. And certainly there's always residential property that people rent instead of owning. And an interesting article came out in Bloomberg Business Week, and this was on February 14th of 2019. The upside of a global downturn, juicy real estate deals. There's many high-end home prices that are being slashed by as much as 30%. So again, we're not saying that high-end homes are the indicator of what most real estate investors are interested in, but the high-end market tells you some things. There's some clues there. First of all, folks that earn a lot of money don't have the same economic reality as your average tenant. And so that market can move. So get back to home flipping, there could be opportunities. I'm generally going to buy a house that has a good chance of being worth more, not just because I forced equity and increased the value and added new amenities and made it nice and new and fabulous, but because also the market is moving in the right direction. These are kind of the opposite of that. And the first market they talk about is London. London has a reputation for being super, super expensive, and sellers of high-end homes in London in the last couple of months have slashed their prices nearly 30%. So that's a big chunk. And a lot of that has to do with the fact that there have been tax changes on luxury properties. Now, this is true in the United States too. Part of the new tax code, as much as it favors real estate, is there are some changes about what becomes deductible based on purchase price. So, and the premise of that is, right, whether you disagree or agree or you're a free market person or you love taxes, the premise is over a certain point of creating just a place for people to live, there is luxury, and luxury gets taxed. It gets taxed in cars, it gets taxed in GST in certain countries, it gets taxed across the board, right? And then, of course, everyone wants the rich to pay more tax because there's money there.
Well, not everyone.
Well, not everyone, but, a lot of folks. So
just
anyway,
the majority.
The majority, right. Let's all vote who should put all their money in, and it would be everybody votes for the person who has the most money to put their money in. Anyway, London, historically a great producing real estate market, is down a lot. Sydney, Australia, down 6% year over year since its median home prices of last year. That's a lot, right? Especially Sydney has been a strong market.
Well, so there's a couple different things. Again, hardly expert in these markets, but I pay attention to what's going on in and around the world. Obviously, London is part of England and Britain has been going through this whole concept of Brexit, and that's created a lot of economic uncertainty. Globally, there's been a wave of populism, and that goes back to this idea that people on the higher end of the spectrum are being looked at as not paying their fair share and needing to do more. And we've seen some of that here in the United States as well. It means that people who have the ability and the mobility to move to a more friendly jurisdiction will do it. New York is suffering from that right now, and we may be talking about that here shortly. But then you look at someplace like Australia, and that's a very different situation. I'm not saying these other conditions don't exist, but there's not a Brexit in Australia. That's a different discussion. But what Australia has is an economy that's largely driven by supplying commodities to the Chinese economy.
Yep.
So if you pay attention to China, which has been one of the largest economic drivers in the post-Great Recession recovery, and a lot of people don't understand that, as goes China, so goes the world. For American investors who have spent their entire career watching America be the driving force of everything globally, it is very foreign I guess that's kind of a pun, to consider that another country would have such a great influence on the United States or the United States economy. But what's going on in Australia could, to a degree, happen to the United States. Obviously, the United States has a bigger economy by some measurements than China. But the point is that China is a major player now. And so as it used to be, as if the United States caught, the cold, the rest of the world caught pneumonia.
Right.
The challenge is China's getting to be that powerful in their economic impact. And so certainly somebody that has got a major relationship with China, like Australia, is going to feel the impact of the slowdown in China. These are the types of things when you're looking at a market. We don't like to talk politics. We don't think that things that happen on the other hemisphere or someplace else in the world could impact us, but really they can. And this is when we're looking at markets, we're looking for clues. Even though these two markets both are behaving similarly, my guess would be on a deeper dive, we'd find out that similar results for different reasons.
We analyzed a market back in 2011 that looked like it had a lot of legs. There was a lot of capital, there was a lot of construction, and that's the market of Dubai. We just had a couple come to the syndication event all the way from Dubai because there's a sense good opportunity, and construction is up. They're going to add another 31,000 homes this year in Dubai. But the prices have come down 25% in the last 4 years. And that's because it's supply and demand. Yes, there's a demand, but there's also a vibrant construction business, and there's plenty of money. And money flows to where it's loved and appreciated, but money flows to real estate because it's a real asset.
Well, if you go back and look at the history of Dubai and that area, that literally was force-fed by very wealthy Middle Eastern families that were making it happen. I mean,
Yep.
they literally just, it's like the way over time Las Vegas was created by the mob. They went out into the desert, which was nothing and very undesirable, and just by force of will and a lot of money, developed an entire oasis, if you will, in the desert. If you look back in the history of Dubai, there's been quite a bit of that. And at some point, if you're successful, you get it over to critical mass, and now it becomes self-sustaining. Las Vegas clearly has become that. It's a vibrant economy, and it's got gravitational pull, and people go there for a lot of reasons. But if you look at the history of Las Vegas, it was like that. And I think if you go back and look at the history of Dubai, it was as well. The concern is that if you buy into a market that's growing because it's being force-fed by whatever force or reason there is, you always have to go back and ask yourself, how durable is that? And have we gotten to that tipping point where the thing has enough legs to stand? I haven't looked at the Dubai market in a long time because it was just not something that interested us personally, but it'd be interesting to see where it's at in that dynamic. Is it really up, and is it fully self-sustaining at this point in time?
Right. Interesting market for sure. And we could spend a whole show on it, but we won't now. We're going to talk instead about Hong Kong. Hong Kong has been a strong real estate market. Interestingly about Hong Kong, though, is like in many parts of the world, real estate denominated in U.S. dollars, their economy is tied to U.S. dollars. And so part of the issue in Hong Kong has been, as we've seen rates increase, and as we've seen our dollar become worth less, same thing has happened there. Hong Kong is down 10% since August of last year, and they're predicting it's going to be down another 10% by this time next year. So that's a drastic change. And again, that's not saying it's good or bad. That's just saying that there's a populous market that has a lot of drivers, and that the prices have trended quickly down. So it's just another clue.
Yeah, and again, I don't have any insight into that. I mean, just watching what's going on in the world globally, it wouldn't surprise me if, certainly just the pullback in general equities, and certainly a lot in the United States in the fourth quarter, especially in December, maybe that had a little bit of an impact. Could be that there's been some geopolitical uncertainty in that part of the world, and that could be part of it. Maybe some of the wealthier people are making moves to someplace. But Hong Kong is generally considered to be very safe for property rights, for personal liberty, for financial stability. It's an economic capital for sure in that part of the world. So it'd be really interesting to dig deeper into that and find out where that's coming from.
We're talking about markets on the move. When we come back, we're going to talk about a market you mentioned, Russ, and that's New York, kind of the epicenter of the world as far as some people are concerned, and an interesting real estate market. It's been in the news a bit too. Also, we'll play real estate trivia before we're done today, give you a chance to win a prize next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Forbes rated Memphis the best cash flow market in the nation. And our good friend Terry Kerr at Mid-South Homebuyers has been the premier turnkey rental property provider in Memphis for over 13 years. With an A+ rating from the Better Business Bureau, Terry has renovated over 750 houses. Real Estate Guys listeners have snapped up hundreds. Discover what these satisfied investors already know. Mid-South's properties are completely renovated with a 1-year warranty and a lifelong rental guarantee. They're affordable, well-managed, and easy to own. Perfect for beginning investors and veterans alike. Get in on the action. Contact Terry and his team via email at midsouth@realestateguysradio.com. Are you looking to create sustainable wealth through agricultural real estate? Then look no further than Agro Nosotros. They're a sustainable specialty agriculture company with specialty coffee farming operations in Panama and fine flavor organic chocolate operations in Belize. Over the last 4 years, they've helped ordinary people to diversify outside of traditional real estate and into offshore agricultural real estate. They don't have your typical tenants, termites, and troubles. Their tenants are trees, and they grow and produce two hugely popular and proven products, coffee and chocolate. Through Agro Nosotros, you can own half-acre parcels in your very own specialty coffee or organic cacao farm, turnkey managed on your behalf, that produce passive cash flow for you and your heirs. And you can feel good about where you put your money to work. Agro Nosotros has socially sustainable programs that provide living wages, improved accommodations, and a steady channel to market to literally hundreds of farmers. And so far, they've placed 61 kids in school. To find out more and see how you can get involved, email agro@realestateguysradio.com. That's agro, A-G-R-O, @realestateguysradio.com.
Hi, this is Darren Hardy, author of The Compound Effect, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio show. Thanks for tuning into the program. Tell a friend about the Real Estate Guys. We're talking today about markets that are on the move and what we can learn as real estate investors. Before we get back to that discussion and some of those reports, let's play real estate trivia. That's your chance to win a prize by knowing today's real estate trivia question. In just a minute, I'll give you a trivia question that has something to do with real estate. And as soon as you think you know the answer or just want to guess, send your best guess to trivia@realestateguysradio.com. Include your name, the answer to the question, and your mailing address. And the first person who gets it right will get a copy of Why the Rich Are Getting Richer by Robert Kiyosaki, one of his most recent books and a good one. That can be yours if you know today's real estate trivia question. Last week, we focused the market spotlight on Salt Lake City, Houston, Texas, and Boise, Idaho, and we asked this: Salt Lake City was originally named something else. What was it? Well, for a long time, it was known as Great Salt Lake City, named for the Great Salt Lake. The great part of the name was dropped in 1868, so it's now Salt Lake City, Utah. Here's our real estate trivia question for this week. Which city boasts the most expensive real estate in the world? Yep, of all the cities around the globe, one is the most expensive per square foot. If you know or think you have a good guess, send it to us to trivia@realestateguysradio.com, trivia@realestateguysradio.com. Include your name, the answer to the question, and your mailing address. If you're the winner, you're going to get a copy of Robert Kiyosaki's awesome book, Why the Rich Are Getting Richer. That's today's real estate trivia question. We're talking about markets on the move. Some are moving up, some are moving down. Your mission is to figure out what markets make sense for you and then do the homework necessary. You know, we talked about New York City, and of course, probably the big news was the whole Amazon thing, which we'll talk about. But in context of pricing, an interesting thing has just happened in Manhattan. For the first time in a long time, the median price of condominiums in Manhattan has dropped below $1 million. That's down nearly 6% from a year ago.
Well, I think there's a couple things going on, most of which have been in the news. But, we mentioned China earlier, and the United States is largely a wealth haven for people in other parts of the world that don't have property rights that are as strong as ours. So if you have the opportunity and you're in a different part of the world to make money and you want to preserve that wealth in something that's very difficult to repatriate or get your hands on, real estate is great. It's one of the reasons why a lot of American real estate investors like to buy foreign real estate. Real estate is only foreign depending on where you're at, right?
Yeah.
The United States is foreign to many people in the world, and they put their money in a foreign jurisdiction in order to protect it. And so there's been a lot of foreign money, especially Chinese money. And of course, with China's economy not doing as well, that could have an impact. Of course, China also is known for various types of capital controls to keep money from fleeing. That could have an impact. But probably one of the other things that's had quite a bit of impact is the tax law change here in the United States. So it used to be, and this is probably, fairly well known if you're listening, but you could deduct your state and local taxes from your federal income tax. And so if you lived in a high tax state like New York, you could mitigate a lot of those high taxes simply by deducting them from your federal liabilities. Well, the new tax law stopped that from happening. And so now you're seeing people who have done the math and said, gee, you know what? It's costing me a lot more money to live in New York, in California, in places with high income tax, and they're moving. and they're moving to change their tax jurisdiction. So this has nothing to do with quality of life. This has nothing to do with population or amenities. It just has to do with the jurisdiction you're under and what happens to you when you're living there. And so we've watched over the years, if you look back over the decades, tax law has a dramatic impact on the desirability of certain types of real estate or certain financing structures of real estate or certain geographies of real estate. In this case, I think New York is a little bit of a victim of that.
Yep.
And on the flip side of that, you look at states, for example, like Florida, who are the beneficiary of that. So you see people on the West Coast moving from California, and they're moving into places like Phoenix and Boise and Las Vegas, Reno. They're the beneficiaries. On the East Coast, you've got people moving from Illinois and from New York into places like Florida, because they have no state income tax and it's more affordable and you get quality of life. And so people that have mobility, and the thing is, in the information age, more and more people have mobility. These are things, as a real estate investor, you have to pay attention to at the macro level so that you can figure out, at the metro level where you want to go, and then drill down to the neighborhood level, which is really where your strategic property and investment decisions are going to get made.
Right. And, people move from market A to market B either in pursuit of something or to get away from something. So people want to get away from a high tax base. Look at Chicago, highest murder rate of any city in the United States by a lot. Well, how often do you want to raise your kids in an environment where people are getting killed at that? I mean, there's lots of reasons people move. And as a landlord, being aware of those is critical. So another thing about New York that's interesting is that for homes over $5 million, those homes are now 22% down from a year ago. Now, still, the prices are amazing. The most expensive property ever sold was sold in New York last year. So there's some good things happening in New York. But overall, markets are down.
That was a $240 million property. Griffin, the fund guy, did that. Amazing.
Yeah. And it was not a big purchase for him relative to his wealth, but largest real estate transaction so far. Hey, let's transition a little bit and just quickly look at some of the richest places in America. So this is a list that came out just recently. Number one, again, same as last year. I think we talked about this last year, where the average household income is $450,000 a year, Atherton, California. So Atherton, we all know Atherton well. We kind of grew up in that area. Number 4 on the list, also nearby Los Altos Hills. Number 5 on the list, Hillsborough, California. So not a surprise that Northern California has a lot of expensive real estate. Number 2 on the list, Scarsdale, New York. And number 6, Short Hills, New Jersey. So all of the markets we've mentioned so far, the median income is over $350,000 a year.
Yeah, so let's jump into that for just a little bit because it's kind of interesting. So, there's some commonalities. You look at New York, which is, Manhattan especially, is on an island. So you have very limited real estate and you have a dynamic financial driver. Wall Street and the banking system is all headquartered there. So gobs and gobs of money, purchasing power, if you will, coming in from all over the world and feeding that machinery. You've got Silicon Valley, which is, you've got a bay, you've got a peninsula, you've got an ocean, you've got mountains. And so basically it's a supply and demand issue with capacity to pay. The capacity to pay is coming through the stock market because what happens is money has been pouring into tech. Tech has been a big part. And of course, lately it's pulled back a little bit, but gobs and gobs of money pours into tech. That money ends up in Silicon Valley through the employees and their stock options, and it ultimately ends up in the local real estate. You could make the argument in Washington, D.C. or Seattle, where you've got big drivers and limited amounts of real estate available, and you get the same supply demand with capacity to pay. So if you're an equity investor, if you're looking for markets where you want to park your wealth and let it just sit there and wait over the long haul, you have to look at the strength and the durability of these drivers. Again, New York has been arguably one of the most popular places for people to park wealth as foreigners. And so what's going on offshore could have an impact on that. Silicon Valley, to a degree, that's also true, but you've also got all the tech people in there who have strong incomes, but a lot of that wealth is also coming from stock and stock options that are being driven through the Wall Street machinery.
Yeah, absolutely. And not saying that you want to be in an expensive market like this as a landlord, but it's just interesting, and there's a lot you can learn from that. You think of the coasts, of course, is where the real estate's going to be the most expensive, but there's some interesting markets here in the top 50 list. Highland Park, Texas, University Park, Texas, South Lake, Texas, all on this list. And Texas hasn't historically been a place where there's been uber wealthy real estate, but always uber wealthy people, right? And so that's part of what this analysis is about. I think, you mentioned Las Vegas earlier. Interesting article came out in one of the Las Vegas newspapers that the greater Las Vegas home prices are up 13% annually in January. So while there are markets that are down, Las Vegas, and we've often said Las Vegas is one of the most resilient markets in the world. It always bounces back. There's always a multitude of drivers. It's not just gaming and vacationers, but Las Vegas is back strong.
Well, I mean, you go back to what I said earlier. You've got, they're adjacent to California, big population base. They've got assault issues, not assault rifles, but assault tax situation where people are moving. You've got affordability issues in California, terrible affordability issues. So if you're based in California, you got friends and family in California, you might even have business in California, moving several states away would be problematic, but you can just take a hop, skip, and a jump, couple-hour flight, hour-and-a-half flight from, pretty much anywhere, a drive from Southern California, and you can be in Las Vegas. And in Las Vegas, you have all the major amenities. You have a great airport. You have, all the shopping, restaurants, all that stuff. They're even going to have a major sports team now coming in. So you've got all that going for you. You've got no state income tax. And the other part of it, you got the baby boomer thing happening. If you're a baby boomer and you're saying, okay, I'm going to downsize, I'm going to sell my expensive California property and going to have a standard of living, but I still want to have reasonable proximity to my friends and family and my old life, but I want to have no state income tax. I want to have an affordable house. I want to have all those amenities. So these are demographic factors. These are tax factors. This is a geographic factor, proximity. I know making the decision to leave California, when I looked around, Las Vegas was a place I ended up for a little while, and then ultimately I ended up in Phoenix. Well, why did I do that? Because I looked around and I said, well, I'm a warm weather guy. I'm not a cold weather guy by any stretch. I did not want to go up north like Oregon, too wet and rainy for me. I did not want to go to Reno because it was too cold and the airport wasn't strong enough to suit my lifestyle. Vegas was definitely on the short list, and I spent some time there for sure. But I looked at Salt Lake City, and that was harder to get in and out of and cold. I looked at Boise, and that was way too cold and hard to get in and out of. And so ultimately, I ended up looking at Phoenix, and that made more sense to me. So this is the process that people are going through. And you have to get in the mind of the demographic and think about what they're thinking about and what they're trying to accomplish. The high net worth people are trying to preserve and protect wealth. They're trying to escape income tax. You've got people who are trying to make a living or retire and make a little bit of equity and income go further, and they're going to be migrating. So while some markets are going to be losers, others are going to be winners. And this is why we say real estate is not an asset class. It's just not. And when you realize that if you understand what's going on dynamically, and we look at these markets, not because we're going to invest in every one of these markets, but Robert, you said it earlier at the top of the show, these things leave clues. And if you can dig through and see the patterns and principles and say, gee, I may never invest in Sydney, Australia, but I'm interested in why that market moved, and why did London move, and why is New York moving, and then why is Las Vegas moving? They're all moving, and they're moving in different directions for different reasons. And the more I understand about that, the more I can learn about the factors that affect supply, demand, capacity to pay with respect to real estate. Then when I begin to see these factors show up other places, and we were talking about Texas earlier. When we first started coming to Texas 10 years ago, it was right after the financial crisis. Prior to the financial crisis, when we were out there looking for hot markets, and you mentioned 4 out of the 5 years prior to the crisis, we'd gone into the number one appreciating market a year or two before it happened. And Dallas, Texas was at the very bottom of the list. There was like 54 major MSAs you were looking at, and you came and said it was number 54. Yep. It's like the most boring equity market you'd ever want to know. Well, after the financial crisis, we started listening to Kenny McElroy, and he was talking about the importance of the energy industry as being a major factor. And then we started really understanding we needed to study markets in a different way in the wake of the financial crisis because the economy had changed. And we came to Dallas, and I remember being on a field trip driving and going, this reminds me of Southern California 30 years ago.
Right.
I think Dallas is going to become more like Los Angeles, and it's going to go from being a sleepy little slow appreciating cash flow market to being an equity market. And here we are 10 years later, and that's exactly what's begun to happen. And so the reason I knew that, not because I knew Dallas, it was because I knew Southern California from having lived through it, and I saw the pattern. I go, I can see the same thing happening in Dallas that happened in LA. So that's why we study markets.
We've been talking primarily about the value of property, median home price. When we come back, we're going to start talking about rent growth and where we see the best opportunities for increasing income from your tenants. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
If you want to learn how you could potentially increase your net worth by over $1 million and quit your job in just a few short years, listen closely for the next 60 seconds. This is Brad Sumrock, and over the past 16 years, I've helped thousands of people invest profitably in real estate, but not just any type of real estate. I specialize in helping people syndicate large apartment buildings so that they can be business owners and investors. In today's competitive environment, it's even more important than ever to leverage an experienced mentor, invest in your education, and have a team of advisors that has established relationships nationwide. And so many people right now seem to be struggling to find deals and then get them funded, but yet Sumrock students are thriving in today's marketplace. We've purchased nearly 7,000 units and nearly $1.5 billion in purchase volume over the past 12 months. And with the new Trump tax laws, apartment investors are positioned now better than ever before to pay even less in taxes. To find out more, send an email to apartmentsnow@realestateguysradio.com and you'll get my recent presentation called Why Apartments Now. That's apartmentsnow@realestateguysradio.com.
Hi, this is Kevin Harrington, an original shark from the hit TV show Shark Tank, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Tell a friend about the Real Estate Guys. You can, of course, download lots of episodes at your favorite podcasting venue or go to our website at realestateguysradio.com. We're talking today about markets on the move and how we study markets, and we haven't gotten into all the fundamentals of markets. We've done shows like that in the past, so you can check the archives, but just where we are in the world right now. Always interested in what the drivers are in a market and who's going there. And one of the big things for landlords, of course, isn't the price of properties, it's what's happening in rent trends. So our good friend Brad Sumrock came out to the Secrets of Successful Syndication and did part of his annual apartment forecast, markets that he likes in apartments. And of course, one of the things they looked at was rent growth. He came out with a great chart that we're going to give him credit for here. And it is the top metros across the United States where rent is growing. The number one market for an increase in rent for the last 12 months, Las Vegas, Nevada.
Yeah.
So it's not surprising that prices have gone up. Number 2, Orlando, Florida. Number 3, Phoenix, Arizona. Number 4, Jacksonville, Florida. Number 5, Tucson. Number 6, Knoxville. Number 7, the Inland Empire in California. Number 8, Tampa and St. Pete. Number 9, Sacramento. And number 10, the northern Los Angeles area. So those are the best markets in terms of rent growth. Now, then what Brad did, and this will be interesting to real estate investors, is he said, let's overlay on that which of these markets is landlord friendly. So that rules out the California markets. They're just not landlord friendly. They're very tenant friendly. Why does that matter? It may be obvious, but if it takes you legally 8, 9, 10 months to get a tenant who doesn't pay out, like it can in California, if the tenant knows what they're doing, then there's no way to recoup that income. That's income loss, as opposed to states where they're very landlord friendly, and if the tenant doesn't pay, they're on the street.
Yeah, obviously that's a cash flow issue and a business-friendly environment issue, and that's going to become more and more important in many ways. But, it's really interesting. We talked if you look at those markets, most of those, I guess, if you were to get down to the property management level and find out where those people are coming from, I'm guessing they're coming in from out of town.
Yeah.
And for all the reasons we've been talking about. So there's a bit of a migration going on right now that we've been talking about here on this show for many, many years that we felt was going to happen as the world continued to experience demographic shifts and economic shifts. And so, again, if you follow us, we probably talked about more than a few of those markets, especially the ones in the landlord-friendly state, because there's really been a lot of opportunity. And, of course, obviously people that acted upon that type of information a few years back have been the beneficiaries of that rent growth. Because
Yes,
I think if you
indeed.
bought the property and you locked in the price when the rents were low, you locked in your financing when the rents were low and the rents went up, well, now you've effectively increased your positive cash flow and your paper equity and the profitability of having the deal. So, again, this is why you do it, right? So that you can be ahead of the curve. Doesn't mean that the ride is over in those places by any stretch. But again, the sooner you see it, the sooner you make your moves, the more likely you are to catch that wave and ride it.
So you mentioned the fact that sometimes and oftentimes when we see growth in rent, it's because people are coming into the market that weren't there before. That's the demand side. And that's why one of the most important things we look at in market metrics is net in-migration. Every day in every market, people are moving in and people are moving out. They're staying, they're going somewhere, they're making a decision to uproot their families for a better lifestyle, a lower cost, closer to relatives, more sunshine, whatever the reason is. But if you look at whether more people are leaving than coming in, that tells you something about the health and viability of the market long term. So obviously, if it looks as though net in-migration is trending positive, more people coming into the market than leaving, that's going to have an effect on home prices based on demand. That's going to have an effect on rent. When folks like builders see that information, they want to answer that need and meet that demand. So they go out and acquire land. They get their necessary permits and entitlements. And the point of that is it takes some time before they can meet the demand. They can't instantly meet the demand. We had Victor Menashe on the program several months back, and he's focused on a really interesting market where there just is not enough housing. People are sleeping in their trucks. They're bringing in RVs. They're trying to bring in cruise ships they can park to house people. I mean, it's crazy. And that's in Lake Charles, Louisiana, where there's a ton going on. If you're interested in why that market is as strong as it is, go back and listen for the show we did over the summer with Victor Menashe. But the point of that is that we want to see where people are moving because that's going to give us a lot of the clues.
Well, think about what we just talked about earlier. We talked about Central Florida, or Florida in general, being the recipient of what's going on in New York.
Yeah.
Right? And so 3 of those cities, Tampa, Orlando, and Jacksonville, are all Central Florida. Doesn't surprise me,
Yeah.
right? We talked about what's going on in California. And so now you see Phoenix and Las Vegas being on that list, right? The people that are at the lower end of the wealth spectrum, the income spectrum, get pushed off the back of the bus as housing becomes unaffordable. And so even if you were to say, look, for example, at the Inland Empire, someplace I'm very familiar with, same thing that I did. I used to live in Huntington Beach, and then as things got more expensive to me, I moved out towards San Bernardino and ended up out there in the Inland Empire. Well, why was I doing that? Eventually, I moved completely out of the state, right? That's what happens. And so, you try to stay as close to friends and family and lifestyle that you can, but eventually you have to make those moves. So again, this is hardly an in-depth analysis of any of these things, but it just doesn't surprise me when you think about what's going on in California and you think about what's going on in New York, that adjacent cities with lower costs are the beneficiaries of increased demand and increased pricing as a result of what many could say are a weakening economy for people on the lower end. And if you're a landlord, that's your target demographic. I mean, unless you find a way to rent to the affluent, like through residential assisted living or resort properties, you're probably going to end up dealing with people that are working class. They're not saving money. I mean, what's the study that said the average person out there, an average family, has less than $400 to deal with an emergency?
Right.
I mean, if they can't even deal with that, how in the heck are they going to make a down payment, right? They're just barely scraping enough to make their rent deposit so that they can even apply to, rent your property. So there's a lot of opportunity in servicing those people. You just want to make sure that you understand who your tenants are, where they're working, where they're coming from. And to your point, Robert, what is kind of the overall pattern in the marketplace? Is the demand increasing or decreasing? And the other side is, what's the ability of the market to increase supply in your niche? Because if you get a lot of people seeing the opportunity and a bunch of supply comes online, then it could end up, mitigating that wave. You can't project rent growth. You put yourself in a position where it could happen. I think you underwrite your deal on what's happening now. And if you get a rent push, good for you. The only exception would be if you buy something that's underperforming and you know that you can go in strategically and improve it and command better rents in today's market at today's rates for a better property.
If you're interested in the multifamily space, Brad Sumrock every year does his predictions webinar, and you can see the archived version of that if you just send an email to forecast@realestateguysradio.com. I'll cut to the chase and give you his top 6 markets for 2019. Brad likes Raleigh and Charlotte. He likes Dallas, Fort Worth, Orlando, Tampa, Jacksonville, which has got one big slice of Florida. He likes Houston, Phoenix, and Las Vegas. To get the rest of the list, plus a lot of nuance on that, just send an email to forecast@realestateguysradio.com. You want to pick a great market before you find a great team and ultimately a great property. And so hopefully we got you stimulated today. It's up to you to do the research necessary, and you really can't be researching dozens of markets. You got to narrow it down. My tactical advice is pick 1, 2, or 3 markets and do the compared to what and go from there. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors. From attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.